Welcome to this week's live ASX strategy session. Thanks for joining me for another show. And don't we have a lot to talk about this week? Movement in the stock markets, plenty of movement in the commodity markets, and of course, any stock codes you'd like me to go through, get them ready. We'll go through those in the second half of the show. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all that, let's get into this week's first chart. And starting off with the ASX 200. The ASX 200, is this persistent selling becoming a problem? And could this accelerate lower? I'll talk more about this in a moment. And then over in the US, I've just seen one of the most extraordinary sentiment surveys I've ever seen, and it really could change the way you see the market. I'll show you what I mean soon. But before we get to that, before we do that, let's start with this latest price action in the ASX 200. So prices have slipped further this week with the ASX 200 breaking to a new low on Monday. So on Monday, prices came down here, broke down to a new low. They've since rebounded over the last couple of days, but really this persistent decline remains in place. So this sets up an interesting structure for the ASX 200. We've got a strong rally off the March low, and then that's been followed by this grinding but ongoing pullback. Now, strong rallies are usually a clear sign of active buying, which is often a bullish characteristic. And I think that's a sign that the underlying trend of the recent years remains up. So when we look back at this, we just stretch it back a bit. This overall ongoing trend, I think the strong buying we've seen off the March low, I think that's indicative of saying that underlying trend remains up. But then that's balanced in the near term by this sagging price action over the last 6 weeks. Look at the structure of the pullback. So when we break this down, we just look at this structure. It's you'll see that it's slow, it's choppy, it's typical of a corrective move when you do get that overlapping choppy decline. But I think it's that constant grind that's most telling. So you can see it's really grinding price action. And so what this suggests, it suggests that the selling pressure hasn't been overwhelming, but it's been persistent, and the buying hasn't been strong enough to stabilize prices, hence that ongoing grind. And this is exactly the sort of price action we often see in ranges. Prices move back and forth. As you can see here, they move back and forth across the moving averages, and they lack that sustained momentum in either direction. Now, we've discussed the possibility of a larger multi-month range for a while now. And I think this sagging price action is another indication that the range is likely to persist for longer yet. And the range I'm talking about, of course, is this big. I think it's about eight or so months. And look, this sagging price action, I don't think this range is ending in the near term. Coming over to the equal weight. So this is the ASX 200 on an equal weight basis. And this is another reason why I think there's more range trading to come. So the structure here is generally weaker than what we see on the ASX 200 chart. And that's because prices are pulling back below declining moving averages. So I've got the 50 and the 100-day moving averages on the chart. You can see they've been declining for a couple of months now. Prices are below the moving averages. I think these declining moving averages add a layer of vulnerability. But at this stage, it doesn't look like the market is on the cusp of a big sell-off. We've got this, and I say that because we've got this clear V-shaped structure. Market sold off heavily, then it rebounded strongly. So you've got that clear V-shape reversal, which is typically bullish. But again, it's the persistent grinding pullback, which we've seen over the last 6 weeks, that persistent grinding pullback, which suggests the market it's still trying to establish a base. It's not ready to try and move higher yet. There's a longer base building phase which is just being drawn out. I'll quickly show you the two key components for the ASX, for the ASX 200, starting with the materials. This is a big reason why I don't think the ASX 200 is on the verge of a breakdown, because materials remain strong. They remain within this large ongoing upward trend. And they've only reasonably recently broken out from this big trading range. And you can see the range here. It was a multi-year range of materials. Prices broke higher, say around November, December last year. And I think this move out of the range, I think this potentially has a lot further to go. But of course, there'll be consolidations along the way. And I think that's what we're seeing now. I think this is all part of a big ongoing consolidation in the materials index, but a consolidation within a rising trend. Prices have come back to the moving averages. You can just see prices have come back, rallied a couple of weeks ago, quickly come back to the moving averages this week. I think upside potential is probably limited over the next few weeks, maybe over the next few months. As I've been saying in recent weeks, I think this needs time to consolidate the big gains off last year's low. So look, the rally from last April through to the high in March, they're big gains, and big gains typically take time to consolidate. I think that's what we're seeing. I think that's what we're seeing play out now. And while overall, I think materials help to underpin the ASX 200, they aren't a tailwind just now. So that, I think, plays into that ASX 200 range scenario. And lastly, just quickly on the financials index, ASX 200 financials, this isn't as strong as materials. We have prices at the lower end of a 7-month range. So here's the range we've been looking at. Prices are at the lower end of the range, and they're also below moving averages, which have just started to cross to the downside. So when that happens, it does introduce that increased vulnerability. The key here is for prices to hold near last week's low. So we had that quick sell-off into last week's low, and that's at the bottom of the range. So I think that while it'd be reasonable for prices to come back and maybe retest the low, I really wouldn't want to see prices spending too much time down near this low or below it. Like a retest of the low, that could still be part of a basing process. But if prices can't rally much from here, so this would be the worrying sign. The worrying sign would be if prices really start to stall around here and then it just doesn't make any headway for a few weeks, it risks setting up that shallow rebound scenario. And when you get the shallow rebounds below declining moving averages, it increases that risk of breakdown. So this isn't what I think is happening, but this is what I'm watching out for. That if we see this price action develop, that can change the way that we look at things. At this stage, this is just a possibility to be aware of. But at this stage, I'm viewing what we have here as an ongoing consolidation within this broader range. But as I point out, there is a risk to monitor. Just back on the ASX 200 briefly, I think this big range could persist for several more months. And as always, it's about managing risk, and that means knowing your exit levels in advance, so not getting caught up in panics like we saw during March, where people don't think about exit levels and then they panic and they sell, and sometimes it's a mistake. So knowing your exit levels in advance, and then also not being scared out of good positions unnecessarily. The timing with ranges is never certain. These big ranges, we never know when they're going to break or which direction they're going to break in. But when they do break, they often lead to strong trends. And I think we need to be patient here and we just need to let this period play out. They do play out. They always do. It's about patience. It's about protecting capital, and I think probably being conservative whilst we work through this ranging phase. Okay, we're going to jump to the US market next and go through what's happening with that. But first of all, though, if you're getting some value from this, please click that like button. And helps me heaps when you click the like button. So please do it now when you're thinking about it, because it sends a message to YouTube's algorithms, and YouTube shows more people the free section of the video, and it helps me heaps. So please do that. Leave a comment. What do you think? How long is this range going to persist, or is it going to break to the upside or the downside? Always interesting to see what you're thinking as well. All right, so over to the S&P 500. And well, after a series of all-time highs, the S&P 500 is finally pausing, at least briefly, to consolidate. So far, it's a shallow pullback with prices only coming back from the high. It's only come back about 2.5%, but nonetheless, it is a consolidation. What's also interesting is that despite the consolidation, the S&P 500, it actually still is up for the week. So, and the relevance of that is depending on Friday's close. So, of course, we're doing this live at around, it's now about 1:15 in the afternoon in Sydney on Friday. Depending on Friday in the US, if the S&P 500 closes up tonight, well, that will be the 8th up week in a row. So 8 in a row if it manages to a positive close tonight. The record winning streak was 9 weeks in a row. That was back in 2023. There've also been several 7 and 8 week streaks over the years, over the last 70 or so years. Now this is interesting. So people often hear about winning streaks and they expect the winning run must come to an end, and of course they do all come to an end. But the market. And that's of course because the market doesn't continue to rise week on week endlessly. But here's the thing that many people don't expect. Long winning streaks have a strong tendency to lead to higher levels in the weeks and months ahead. And this is the thing to remember with trends, with trending markets. They have a habit of surprising people. A strong trend can last longer and travel further than most people expect. Of course, there's no guarantee that this uptrend that we currently have will keep surprising on the upside. It's entirely possible that the top could already be in. Like, we can't say that it's not. But I think the benefit of the doubt goes to the incumbent trend, and that clearly remains up, and it has remained up for some time, notwithstanding these corrections along the way. It's interesting. People love to pick tops. I see all sorts of commentary across the internet in terms of picking tops, and it's always the case. There's always people picking tops, and it's interesting. Picking tops, it sounds clever. And that's probably because it tries to outsmart people by predicting what's going to come next. And sometimes people do call the top. But most of the time, I find that trends endure, and forecasts for trends to end are more often than not wrong. So I think there's a good chance we see further consolidation in the near term, but I also think that being bearish into a rising market, I think it's a mistake. Overall, over time, being bearish into rising markets is typically a way to miss out. One of the arguments I keep hearing on the bearish side is that participation is low, and I think that is right to an extent. Participation isn't booming. So by participation, that means the number of stocks participating in the rally. But look, I think participation, it's not like crashed out either. Have a look at this. Have a look at the equal weight. So this is the S&P 500 on an equal weight basis. I think the equal weight is important to monitor, as it's not dominated by one sector. It's not dominated by a few mega stocks. It really needs all 500 to do their bit to create movement in the index. Now, the structure here, this is positive structure. Like, look at the rally off the March low. It's a strong rally followed by a sideways consolidation towards the moving averages. Now, that's a sign the dip is being bought. When you get these shallow consolidations in the moving averages, it's a sign the dip is being bought. I think the equal weight is on the verge of a new all-time high. And then we can look at, say, let's look at the financials. We don't usually look at this. We don't go into the sectors normally, but just for the sake of today, let's have a look at the financials ETF, because financials is, of course, a big part of the market. When the financials are breaking down, it's a concern for the market generally. And we look at this. Financials are, look, this is further. This is clearly further from the all-time high than the S&P 500 or the Nasdaq. So this has been contributing to that weak participation. But look at the structure. Look at the structure. There's a strong rally off the March low, and then look at the shallow corrective-looking consolidation that's followed. So financials aren't breaking down. This isn't a bearish structure. In fact, it looks like a market that's setting up to rally, to test higher. So I won't go through all the sectors, but I think there's scope for participation to improve, which in turn supports higher prices. Quick look at the Nasdaq, and I won't spend too much time on this. We've done this in previous weeks. We've discussed the potential for a pause over the last couple of weeks. Last couple of weeks, been talking about, look, the Nasdaq looks like it's had a big run. It looks like it's ready for a pause, and that's been due to prices being historically stretched above the 50-day moving average. That's this indicator I have below. The indicator below shows how far above or below the 50-day moving average. That's this red line. That's the 50-day moving average. When prices get stretched above, you get this indicator rises. It was recently up at around just below 12%. So prices 12% above the 50-day moving average, and it's a rare occurrence when that happens. You can go back to, I went through a whole lot of examples 2 weeks ago. So if you didn't catch that, go back and review that video, and we go through that there. And the interesting thing is that an extreme in the indicator, like we've just seen, an extreme often doesn't lead to a top. Rather, it indicates bullish conditions. So as I say, go back and look at those examples from a couple of weeks back. Now, so this now appears to be part of the mild pullback. We're talking about the potential for a mild pullback, and I think this looks like it's signs of that mild pullback developing. I don't think this comes all the way back to the 50-day moving average. I think this is mild. I think it's maybe sideways chop before potentially another rally. I'll show you why I think the odds favour sideways chop and not a larger correction. I want to show you this survey. This really is extraordinary. So we've looked at this for the last couple of weeks. It's the American Association of Individual Investors survey. Comes out every Thursday. And what's extraordinary here is the surge in bearishness. It is really just taken off in the last week, and this is at a time when the market is just below an all-time high. So the percentage of bears have jumped 7% in 1 week. They've jumped from 36.6 to 43.6%. So it's jumped 7% in a week, and and also the bulls, the percentage of bulls, that's dropped. Percentage of bulls has dropped from 39 to just below 32%. And the bullish reading is well below the historical average of 37.5. Currently 31.7% bulls. Historically, it's 37.5%. So you think about that. The market's at all-time highs, and we have below average bullishness and the sort of bearishness I'd expect after the market is down 20% or something. It's so according to this survey, people don't believe the rally and they anticipate a reversal. Now, this is just one survey. I've seen other studies suggesting investors are actually overweight equities. So we shouldn't take one thing as a guiding light. We want to cross-check it with other things. We want to look at the price action. But there does seem to be a lot of disbelief. And that's not how uptrends usually end. Uptrends usually do not end with disbelief. So just quickly back to the S&P 500. As I was saying earlier, these trends, they often surprise, and I think the odds favour this one has further to run. As I said last week, the money's made by staying on trends, not trying to pick tops, and I think the odds favour staying on this move. My approach here is it's staying long, it's staying with the trend, but at the same time, and I do stress, it's not being complacent. Risk management is essential, and it always is. It's essential now. It's always essential, but really not being complacent, staying with the trend, but not getting carried away. If it all turns around and falls quickly, then a good exit strategy, well, that's what I use to minimize downside. I want to participate while it's going up. I want to stay with it. I want to give it the benefit of the doubt, but I want to have an exit plan for if and when the situation changes. Okay, so we're going to jump over to the US small caps now. And then after that, we've got the local small caps. We've got the commodities. Any stock codes you'd like to go through, get them ready. We're going to go through those in the second half of the show. But as always, that wraps up the free section. If you're not a strategy session member, there's a link below. Click that. Come on in. Doesn't cost you very much. And we're going to go through a whole heap of other stuff, which I'm sure you're going to find really interesting. All right, so over to the Russell. Let me just find our chart for the Russell. Here we go.